Right. So, hi everyone. Welcome for this session. It's heartening to again see you all as part of the webinar series. In fact, in a lot of sense, it's a very special evening uh, because 4 years before, on the same day, actually, I had booked analyticsvidhya.com as a domain and it started this blog. So it was 12th of April 2013 when the domain was booked. It's special to kind of come back and then do this webinar on the same day as part of the DataFest. So what I'll be doing today is I'll just cover some use cases and basics of insurance and how analytics gets applied in insurance. And as you might be aware, this is happening as part of DataFest. So let me start the webinar. If you have any questions, you can feel free to use the Q&A session. I'll take the questions at the end. So feel free to ask your questions at the session as the session progresses. Right. So let me start with the webinar. Right. I hope my screen is visible to you. And as I said, it's a very special evening, very special occasion for me personally and for Analytics Vidhya as well. So just a quick background about myself before we start, in case some of you don't know. So I'm Kunal. In terms of my experience, I passed out of IIT Bombay in 2006 and then went on to work with Capital One. So Capital One is one of the top five banks in US. So I spent about 3.5 years working with Capital One, and then came back to India in 2010. At that time, Aviva Life Insurance was setting up its analytics team. So I joined that team, and then we scaled that team from a 2-member team to a 20-member team. And it was during this period that I learned about how analytics can kind of be applied in insurance as a domain. And in today's session, I'm kind of just reliving some of those experiences. And then so over the last 7 years, I've worked with various insurance companies, how they use analytics and data science. And then I hope that this session would be useful for people to kind of get the subject, at least the basics of the subject. Right, so I'll start the session. As I said, this webinar is happening as part of DataFest 2017. DataFest 2017 is a festival to kind of mark 4-year anniversary for Analytics Vidhya. So during this period, there are various competitions happening. I'm sure you would have seen some of them around. There are various webinars and networking events happening, and there is something very special which we are starting in a few days, which is Data Hack R, where we'll kind of give you learning agenda or problems to be solved on a daily basis. So there's a lot of exciting stuff happening during this period. Make sure you follow, make sure you kind of are subscribed to the feed. There are various hackathons and competitions coming up later in the month. So I hope to see all of you around during this period. So this is just a gist of various formats and various competitions. Uh, 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 Total prize money during this month, which is up for grabs, is more than $10,000. A few competitions have already happened. A few of them are coming up. And the top three winners of DataFest take away about $3,000 in cash prizes. So with that, let me kind of come to the session of this webinar. So this is broadly how the flow of the webinar is. So I'll start with basics of insurance. How does the industry work? What are how is a insurance product structured in industry? Uh, And then I'll come to use of analytics and data science in insurance industry. I'll bring out some of the challenges which insurance companies are facing, and how analytics and data science helps in solving some of those challenges. And towards the end, we'll just briefly touch upon some of the things which can be expected in future. So this is just kind of a very, very brief summary. So before we start, just to take again a quick sense of the audience, let me quickly share a poll. Sam, you'll see a poll coming up on your screen to just uh, help me understand how many of you kind of use insurance. Uh, so, so the question is, how many of you have a life insurance with a cover of at least 5 times your annual income? Right. So if you're, let's say, if your income is $10,000, do you have a life insurance cover of at least $50,000, or in rupee terms, if you're, let's say, earning 10 lakh rupees, do you have a cover of 50 lakh rupees? Okay, I'll kind of end the poll. Uh, so I'll just share the results so that people kind of can see the results. So about 30% of people carry that cover. Interesting. Let me ask a similar question for health insurance. So how many of you have a health insurance which is at least where the cover size is at least 10% of your annual income? Again, very interesting results. So this is kind of half and half. So about half of you have a health insurance. So it's interesting that people actually have a reasonable health insurance, but not a life insurance as much. And again, finally, so for those of you who have any insurance product, what was the kind of reason why you bought that product? Was it because of you actually wanted to cover risk, or it was sold to you as an investment instrument or a tax saving instrument, or some others would be all possible reasons? So someone pressurized you without actually having any specific reason to any kind of other reason would fall in that category. Interesting again. So again, I'll just share the results. So for those of you who have insurance as a product, looks like less than half of you have actually bought it for the risk cover which it provides, and then that's exactly that's, I think, kind of representative of uh, a few countries where insurance is kind of structured in that manner, and India happens to be one of them, where a lot of people buy insurance because of the tax savings attached to the instrument rather than the actual risk cover. So let me come to kind of insurance as a subject. So as you would know, basically insurance is a simple tool where you kind of pool risk of various individuals and cover for those losses. So essentially, you form a group of X number of people, and this X number could be anywhere between, let's say, 100 people on the lower side, or a few hundreds on the lower side, to thousands or millions of people. Uh, and any kind of and what you cover through insurance is basically any uncertainty which you have, and this uncertainty could be related to your life, your health, or any unfortunate event which might happen. And then the cover only gets activated when the unfortunate event happens, right? So uh, if you covered for a risk and that scenario didn't happen, that insurance kind of doesn't get activated. So insurance as a product only gets activated when the unfortunate event happens, right? So in that sense, it's like a friend who takes money from you in good times, and then kind of gives you back in case you are in bad need of money. So it's a kind of very simple analogy. If you look at the kind of insurances, so again depends on your need. So broadly, I've classified insurance in two buckets: life insurance and non-life insurance. So within life insurance, again there are various kinds of products. So a term product is where I say that for a predefined time period, if anything happens to me, there is a cover which takes care for my family. So basically, my income gets replaced by that cover. Similarly, investment is a product as when I invest, when a part of the insurance gets invested in some funds or some investment-driven products, and then you get the return. So your cover is may or may not be linked to the performance on the investment side in that case. Right. Similarly, on the non-life insurance, you have health insurance, motor insurance, you have fire and house insurance. People cover various events or various risks. So at a conceptual level, if you can size a risk, you can always basically price for it, right? So at the heart of it, insurance is basically a mathematical kind of equation where you try and price for a risk, add your premium, and then kind of sell it to a large number of people. You need a large number of people because the probabilities have to play out. On a small scale, it kind of becomes very dependent on the scenario. So typically you would see insurance working only in large numbers. Right. So with that, let me kind of come to a question, or actually even before that, let me just float another poll quickly to understand what's your view about insurance as a product. So if you were to compare insurance with a credit card, what do you think? So which out of the two products is kind of more complex from data complexity perspective? So do you get more data or do you get less data? The kind of data you would see, is it more complex, less complex? So what's your sense on complexity of insurance as a product? Interesting results. So again, I'm just sharing the results. So about half of you actually think it's more complex than credit card, and honestly, there is no correct answer to it, because insurance kind of plays at two levels. So if you look at it from a transactional perspective, or data collection perspective, it's much simpler product than, let's say, a credit card, because you typically engage with customers once in a year or maybe 12 times in a year if your premium is getting collected on a monthly basis, right? So the number of transactions which you'll see in your systems, or the data which you'll see flowing in your systems, would be at a relatively smaller scale compared to, let's say, credit cards. On the other hand, the uncertainty or the risk coverage is very high compared to credit cards. In credit cards, you probably look at, let's say, 8 to 10 years kind of risk at the maximum. And there also, I mean, typically credit cards would be so as long as you can manage risks for the first few years, you would be profitable on the portfolio level. Whereas in insurance, that can kind of become very difficult because you're looking at a very long term product. So you cover people for, let's say, 25 years of insurance, or you cover uh, various risks on a much longer duration, right? So that kind of brings me to the next question, that how many of you actually think whether insurance the industry is profitable or not? And then let me kind of share some numbers or some information about it. So if you look at, and this is right now specifically for India, but there are similar examples across across countries. So if you look at the total losses by private life insurance companies in India, they are at the tune of kind of 187 billion rupees, right? So that's 18,700 crores. On the other end, there is a single player, LIC, as most of you would know. For those of you who don't know, this is like uh, biggest insurance company based out of India. And in a single year, their profit were more than the cumulative losses for most of the uh, other players combined, right? So to the tune of 200 billion rupees, 20,000 crore rupees. So what do you think is kind of going on? So why is one company kind of making these huge profits, other company uh, making still losses, or are kind of still figuring their way out of to come in profitability? And to kind of understand that, let's quickly understand the economics of how insurance works. uh, so let me take up a scenario that, let's say you uh, buy insurance for 25 years. So a 30-year-old person buys insurance for next 25 years of his life. The cover which he gets typically, and these numbers are representative of what's happening in India as a country, at least. So you kind of get a cover of 20 million rupees or 2 crore rupees for a premium of 20,000 per annum, right? If this was the case, so from the insurer's perspective, what are some of the, let's say, what are some of the uh, uh, expenses which people, which the insurance company would kind of pay, or what are the expenses which the insurance companies would need to bear upfront, let's say, in underwriting this insurance? So, and then you can use the chat window to kind of give answers. So someone just told agency commissions. That's right. Any other kind of expenses which people can think of? So in underwriting this insurance, what are the expenses which insurance company would incur? Right, advertising, marketing, branding. Actuaries. So you need to price for that. Uh, so right, so there are various costs which, and if I kind of size them, claims is another one. So here is how the equation works out, right? So typically the marketing and commissions are about, so depending on the channel of your acquisition, it can be 10% on the lower side to almost 40% on the upper side. Then in order to kind of cover for your risk, you have to keep reserves from your product aside, and then that depends heavily on the quality of underwriting which you do. So if you're underwriting a riskier portfolio, you will need to keep higher reserves. If your quality of underwriting is good, and by underwriting what I mean is essentially the quality of risk which you are undertaking. So if you're selectively taking people who have, let's say, good health, then you'll need to keep less reserves, right? There will be some policy setup charges, printing charges. You'll need to send these policies to your customers, and over and above that, you'll need to arrange for medical tests for these people, right? So if you look at typically what happens, even in a simple product like a term insurance, So you can ignore the allocation part in this chart. Basically, what happens is whatever so that you can see two bars graphs here. So where the right hand bar just shows the premium and the left hand bar actually shows the kind of expenses which the insurance companies are putting in. So what you can see is in the initial years, uh, basically the insurance companies kind of fund to underwrite the policy, right? So the insurance companies kind of pay from their pockets to get these policies set up, and they kind of fund the upfront underwriting, and their hope is that in the later years the charges would be much higher than what the actual expenses would be, right? So that's kind of how the equation plays out. So insurance as a product is meant for a long-term play where you kind of take some upfront investments. You can say investments in these policies. So you have to kind of sponsor these policies upfront, and then you hope to recover the money later on. So what it essentially means is that insurance company can only make profits if basically there are various conditions which kind of meet. So obviously the pricing is healthy, so they have to make sure that they price the products right. Then second is the operations and distributions costs are under check, because if your costs kind of increase, then you would not be able to become profitable. And finally, and probably the most important point, is that the customers should continue to renew the policy for at least a few years, right? So in a hypothetical situation, let's say where every customer stops paying the premium after the first year, and then I'm right now talking about a simple, let's say, term product. Uh, Actually, the insurance company would kind of make losses at the end of the year if no one pays you the second year premium or the third year premium. So that's basically a background to keep in mind, that insurance as a product is a long term game. Companies have to be very, very prudent about the kind of investments they do in operations and distributions. The product works only when customers continue to renew their policies. And these are some of the things which kind of dictate how analytics gets used in the industry, and why analytics can make a huge impact in insurance as a domain, right? So let's now come to various aspects of an insurance company, and then we'll look at a few case studies of how insurance gets applied. So broadly, what I've done is I've classified the operations of a insurance company in four verticals. The first one is finance or risk, where you start with pricing your products. So you kind of look at what is the risk which you are signing up for, and you price that through premiums, right? So that's the underwriting and pricing part. And you have to make sure that you continuously check for frauds, and you make sure you invest the money which you get very, very prudently. So that's one aspect. And again, analytics can be used very, very heavily in these. So starting from pricing to underwriting to fraud detection, each of these problems can be solved through analytics. The second section is basically acquisition of your customers, and again there are various applications, starting from managing the distribution channels. So how does insurance get sold? So it might get sold through various agents, it might get sold through banks, it might get sold through let's say online channels or online brokers. So there are various ways in which insurance gets sold. And then again, you have to kind of manage which channel do you focus on, how much do you pay these channels, what kind of rewards do you run, so all of these problems, again, analytics kind of plays a very important role. And then there obviously there is marketing analytics, so your digital marketing versus your offline marketing or your market mix modeling. So those are some of the areas where analytics gets used. Once a customer is on your book, so then the question comes up to that: how can you increase the customer life cycle value? And that starts with your various cross sell and upsell models. So if a customer hasn't signed up for the right premium amount, you you ask the customers to kind of take a better product, or take a higher insurance, a higher cover or higher premium product. uh, the second thing is retention. So as I said, that it's very very critical that customers stay for a longer duration. So retention becomes a very critical aspect, and retention simply means, in very very simple terms, that whether people are paying you a second premium or a third premium or not, right? And then there is lapsation and reinstatement. So if a policy lapsed, then lapse policy essentially means that the customer did not pay you a second or a third premium or whatever year, so the renewal premium did not come. In some cases you can reinstate the policy as well, right? So again, analytics. The beauty about customer management problems is that you have a lot of data during this period. So you know what are the products the customer already has. You know what life stage the customer is at. You also have some reads into the behavior of the customer. So you typically have much more data at this stage than what your acquisition stage would look like. And finally, the fourth bucket is basically operations. So starting from various branch operations, underwriting, or how do you handle customer complaints, to customer management, which queries get prioritized first, how do policies move from one bucket to another bucket, how are your products set up in your systems. So those are basically the kind of four verticals. What I'll do in the next few minutes is kind of take case studies from each of these sections, very quick case studies, and then we'll come to the Q&A section. Uh, Right. So let's start with a quick case study. This is on the acquisition side. So I've kind of removed any confidential information for this client, but basically this was an insurance company selling insurance through agency channel, right? And then the company was making losses when actually they should have moved into profits. So when we looked at the problem, because the main channel for this company was agency, uh, there could be various reasons why the company was not making profits, starting from high operating costs to brand presence not being as strong to products not being competitive. So what we did was we said that the revenue which the company gets can be simply written in a mathematical format as the number of agents multiplied by the premium which you get from each agent, and the agents can then be divided in the new agents and the old agents. And the minute you write down a equation like this, you kind of see the levers you have, right? So there is so if you're not making enough revenue, it could be because you have either less number of agents, or the production from these agents is not as high, right? Again, if you drill down further, uh, the old agents is a given thing for you, so you can't change the number of old agents. At the same time, because these agents are freelancers, it's very difficult to change their behavior as well. So the most of the leverage which you have is in identifying new agents and then hiring them right. So we said that the business problem, which was that your efficiency is not good, kind of gets converted into making sure that right agents come into your funnel, or right agents get hired. And when we saw actually the funnel of the for how agents are getting recruited, this is what we saw. So for every 100 applications which this insurer was kind of getting, they were only seeing 30% agents coming on board. So there was an examination which was required as a regulatory requirement. And out of these agents who were coming on board, only half of them were actually giving any business to the company. Right. So from the company's perspective, they were going out and hiring a lot of people or agents. A lot of people were applying, but finally when it came down to number of people who were doing active business for the company, there were only a handful number of people. So what we said was basically, given these numbers, and then what we saw was more than 80% of agents did not do enough business to recover even the upfront costs. Can we use data to kind of identify who would be our best agents? Right. So if I were to ask you, and again you can use the chat window functionality, that what are the factors you can look at in finding which agent is going to be a good agent? What would that be some of the parameters? So what would define who could be a good agent or not? Right. So age, yes. Number of policies sold. So this is at the application stage, right? So you don't know whether they've sold an insurance product. So education, the demographics, his network, industry, right? So those are exactly the reasons. So let's say you have some of this information would be available to you, some of that information would not be available to you. So let's say you have that information. What would you do next to kind of identify who are good agents and who are bad agents? So let's say you have that data. So what would you do? So a predictive model at time of hiring, right? So that was exactly what we did. So we said that if there is any way to kind of predict or segment the customers, segment the agents into various classes, we would start looking at them differently. And if we are able to identify different segments, we can handle them differently. So someone who is, let's say, scoring good in exams or scoring good or clearing exam but not getting enough performance can be trained with a product training, versus someone who is finding it difficult to clear the exam, the intervention for them would be different, right? So those are some of the methods. Another thing to keep in mind is you have to ultimately implement this through a sales channel, because the recruitment of the agents happens through a sales distribution channel. So there is a sales manager who goes on field and brings the agents who can sell insurance. So any model which you implement has to be simple enough or has to be implemented in a manner that the sales people on field can actually use it. Some companies did try psychometric tests as well, and then so the results, in some cases there were some interesting use cases. So psychometric could be another way. So what we did, so we looked at various possible factors, starting from age, gender, marital status, the designation of the sales manager. So I won't spend a lot of time on these variables, but the idea is that we looked at a lot of these variables and created the profile of these agents, and this is how various profiles panned out. So we had the productivity on one axis, and we have how many agents actually come on board. So we saw a good spread between some profiles which were not productive at all to some profiles which were highly productive. Excuse me. Right. So this was one use case, and uh, no, so these are just the variables. They are not in importance. I can't share those details over here. But so what I've given you is just a sample list. It doesn't have all the variables as well. This is just to kind of bring out the point. Once these profiles were identified, then the idea, the next question was, how do you use that information? And again, so what we did was we said that let's try and incentivize the profiles to perform better. So we said that for profile one, which is kind of our best performing profile, we'll not charge them any fee if they want to become agent. On the other hand, profiles which are not performing well, we'll kind of charge them a higher fee. Uh, and this is the kind of result which came in, and the size of bubble kind of shows how many people were there in that kind of population. So what you see is that the performance, so the minute you had a differential pricing, even the originally the profiles which are not performing good started moving and improved their performance. So this was one example of how analytics could kind of help and create efficiency for insurance company. So this was a use case on the acquisition side. Uh, I'll try and see. So coming back, let's look at a few other examples, and then we'll open the floor for Q&A. So the second area which I said was customer management and retention. And as I said before as well, so you have a lot more information at this stage. You know about what did the customer do. You also have information about how much premium did the person give in past, or what are the channels through which the customer is contactable, right? And to again help you understand the criticality. So as I said, that insurance products are only profitable when you kind of stay when the customer stays for long term. So this is kind of the most important problem after pricing. And just to give you an impact, so if you look at the top three insurers in India, for example, uh, the difference between two of them is in their persistency rates is very high. So 15% difference. And persistency essentially just means what percentage of people pay you renewal premium, right? So I'm just kind of keeping it simple. So 15% difference in the persistency can translate into in let's on a bucket size of $150 billion can translate into $22 billion of your top line as well as bottom line in this case, right? So in that case, uh, persistency is kind of the most important thing. And now if you think about it, you can also see what kind of data would you have, or what kind of questions would you have if you have to improve your retention, right? So so the questions which you will have is, okay, if I have to remind the customer about a due premium, what channels do I use to contact to the customer? What kind of intensity should I call them with? Should I call them very frequently, uh, or should I call them at a lower frequency to start with, and then you can increase that over time. You can try out various things, and the idea is to make sure that you collect the premium from customer, or you kind of keep the policy alive without actually compromising on the experience, or without hurting your brand. So that's kind of the problem. And if you think about it again, this is probably the biggest data problem for a company. So as I said, the difference or the impact which even a percentage movement can have on the insurance company is huge. So any uplift which you can bring in by identifying which customers are likely to pay a premium, or which customers are not likely to pay a premium, you can bring in huge business benefits, right? So again, let's just reflect what can we do to kind of solve this problem. So let's say for a company which has uh, let's say 100,000 customers, and then I'm taking it at a very small scale. Typically, any insurance company would have more than that. Or let's say a company which has 10 million customers. Uh, if there are 10 million active customers, what would you think would be the size of the data which you would be dealing with? Let's say you are the data scientist and you've been assigned to create a model which tells which customer is likely to pay a second year premium or not, right? So if there are 10 million customers, how many data points would you have? So you would have 10 million rows. Even if, let's say, there is a table on customer level, you would have all the interactions with these customers in past. So if at any point in time, if these customers have called at your call center, if at any point in time these people have raised any service request, you will have all that information. You will have the logs from the calls. You will have any interactions with them. You will have the information about the agents who have sold the policy to them, or the bank partners who have sold the policy to them and serviced those policies. Uh, right. So even if you were to simplify this problem, you are talking about 10 uh, uh, million rows multiplied by each of these variables. So this is kind of the biggest data problem which a retention customer would have. So my question was basically, what would be the size of data? And then the next thing is, okay, if I were to identify, so who is likely to pay a premium or not, what kind of techniques can we use? So if I have to identify which customers are likely to pay me a second premium, uh, what are some of the techniques you can use? So you can use logistic regression. You can use, let's say, decision trees. Do you think you can use something like SVM? Right. So SVM would be exactly. So SVM would take a lot of resources. So it would be very difficult to apply SVM at this scale until unless you have access to huge resources. With right. So this is one problem where you have to manage complexity with the time it takes to run these models, because these customers would come up for renewal on a monthly basis, or you'll need to decide these strategies in a dynamic manner, right? So that's kind of again one of the biggest problems. So if you talk to any CEO of an insurance company, customer retention would be one of the top problems in their mind. And again, a lot of analytics typically goes through in devising these strategies: whom to contact, when to contact, how to contact, how to do follow-ups, which channels to use. So do you ask your agents to go and collect the premium, or you make a call through your call centers? Do you send SMS alerts to your customers? And so those are the kind of questions which you'll need to answer using the data and the past logs. Right. Coming to the third case study, and then again in kind of the overall wheel, I'm now talking about the underwriting part. And again, just to give you a idea, so let's say I'm again going back to the similar example, that there is a 35-year-old person who is taking insurance for 20 years, right? So in today's market, if you have to go and actually buy a insurance like that, it will cost you approximately 20,000 rupees for getting a cover of 20 million rupees, right? Uh, the probability, which again I have just picked up from the actuary guidance, of the death in the next 1 year would be around 0.09%. Right. So what that means is, for every 10,000 customers who buy this insurance, uh, 9 of them would normally die in the next year. Right. So if you have to pay out these claims, so you kind of pay out a huge amount of the revenue which you earned, in kind of servicing these claims, right? So your underwriting becomes very, very important. So the more favorable your underwriting is, so this guidance I've just picked from at an average level for this age bucket. If you do better underwriting, so if you sign up better customers, your rates would be better. But the point which I wanted to tell was that out of 10,000 customers, even if two customers end up doing fraud, right? So if two customers are able to do a fraud and get a claim out, you would end up making losses, right? So this is a problem where you are working on very, very highly unbalanced classes. So you kind of you have to segregate signal from noise in a very, very efficient manner. The problem becomes much severe for motor insurance companies because the number of frauds which happen is very high. And again, in India, there are a lot of fraud claims which which happen in motor insurance. Life insurance is better, but the sensitivity to the fraud on life insurance is also very high. So, right. So that's basically the claims side. So motor insurance is basically covering any of your vehicles. Auto insurance, actually, I should have said auto insurance, right? So so that's kind of another area where you use data very heavily to see if there are any underlying trends in fraud happening. So are there particular agents who help their customers to take claims in a fraudulent manner, or there are any particular shops which are using fraudulent practices to create claims, or are there hospitals which are issuing fake death certificates? And these are all some of the problems which need to be answered based on the data. What techniques would you use? So in these particular cases, the techniques are actually a mix of database techniques and detective analysis. So you kind of look for patterns against the assumptions which you had made, and anywhere if you see a huge deviation, you then go into investigative mode and try and understand what is happening. So it's a mix of database techniques as well as some detective analysis which happens. Right. So broadly, those are some of the case studies I just wanted to touch upon. So at a very high level, as I said, if I were to just summarize what I presented, insurance as a product is relatively simple in a transactional manner, but some of the questions or answers that you need to get to by using analytics are much more difficult because you are underwriting risk for a much longer duration. So in that sense, you are looking at much bigger risks. There are various examples starting from customer retention to cross-sell, upsell, customer acquisition to fraud investment, which I have used, which I just shared to kind of give you a flavor. I obviously didn't have time to kind of cover a lot of details, but just wanted to give you an overview, and then maybe we can cover some of them as part of the question and answers which follow the session later on. Right, so that's broadly how things stand today, how analytics gets used in industry. Moving forward, I think insurance as an industry is very interesting because you are getting more and more data. Uh, so, for example, think of data which is coming from vehicles, telematics, or think of data which can come from, let's say, health bands or monitoring bands, CCTV footages, or satellite data. So as machine learning basically grows and creates more impact, you get more and more data which can be used to solve some of these problems, starting from better underwriting to finding data or evidences from, let's say, video footages at a large scale, or making sense of the customer interactions or so if you use NLP techniques, you can drill down what the customer is trying to say or what are some of the pain points. So all of those are insurance as a segment is benefiting a lot by getting more additional sources of data. The second aspect which would change in future is kind of the operations cost would continue to go down. So as per a study done by McKinsey recently, McKinsey said that they expect at least 25% of roles to kind of get automated in a period of next 3 to 5 years in insurance. So automation and especially on the operations side would continue to make a huge impact in the industry, and that directly impacts the efficiencies and the profitability of the sector, right? And then finally move to personalized pricing and insurance covers. So right now, most of the products in industry work at a portfolio level. None of the companies, at least whom I am aware of, has moved to a personalized pricing. Which essentially means that you get a price based on exactly your attributes. So that's not the case as of now. While there is some segregation, the segregation is typically on a very high level. So it typically is a function of your age, gender, and some of other demographics, and that's where it stops. So with more data, you would move to more personalized pricing, and then you'll get more personalized covers, right? So those are some of the underlying trends in the industry. What I'll do next is kind of move to the Q&A section, take these questions one by one. So if you have any questions, you can post them in the Q&A section, and I'll take them from there. Right. Coming to right. Can you please give your views on how to use business analytics and especially R for predicting stock market? So that's not relevant for this particular session, so I'll skip that. What is a crore? Sorry if I use that terminology. It's a unit used commonly in India. So 1 billion is 100 crores. So you can use that conversion, but it's basically. Abhishek said that, can you give an example of agency channel? So agency channel is basically a setup where you don't actually go out and hire a lot of freelancers to sell your products. So some of the very good examples of agency channels are, for example, what Amway does, or what some of the other companies do. So they hire people as freelancers, and people get commissions when they make sales. The next question is, I wanted to know which one would be better career between business analytics and insurance domain and an actuary. I have interest in both. So very good question, Bhaskarji. So I think the answer kind of depends on two factors. Personally, I think that surviving only as an actuary would be difficult going forward, because the kind of segmentation which you can do based on data is going to become more and more powerful. And until unless actuaries kind of bring them that discipline in their coursework or in the way they kind of price the problem, it's my view is that it would be difficult to kind of stay relevant. So, but at the same time, there is a lot of domain-specific information which is there in the actuary coursework. So, what I would do is, if you are interested in both, start taking some of the actuary papers and then start applying analytics parallelly. And ideally, both of best of both worlds should give you the best exposure. Kamlesh is asking, my question is that how we can use fraud analytics in health insurance industry where data is unstructured, i.e. we have medical bills in PDF format and discharge summary of patient, and these PDFs have no uniform format. What method would you could be used? Again, very good question, Kamlesh. It's a very impeding problem for a lot of people. Some of the techniques on, again, NLP and data extraction from unstructured data is what people are working on. I know of a few startups which are actually trying to convert these data into digital format. So there is a company which kind of converts, which is trying to convert the prescription of doctors into a digital format. So that's those kind of things would probably help the industry move in the right direction. But that's actually an active problem. Why is agency commission so high? A lot of mis-selling happens because first year commissions are very high. Long tail of revenue sometimes is not as big as first year commissions. True, Anjali. Thankfully, things are moving in the right direction, at least in India. IRDA, the regulatory body, has again created more stricter laws around what your first year commissions could be. So that should again kind of change some of these things. But yeah, if we keep first year insurance commissions high, then there is a good incentive for mis-selling. What are some of the machine learning exploration techniques in health insurance that can potentially be explored as a POC? Again, a very interesting question, Supratik. So this is from Supratik. So what I would say, Supratik, is start with a business problem rather than what machine learning exploration can be done in health insurance, right? So look at what is the problem which the business needs to solve, and is it on customer retention side? Is it on doing a better pricing? And machine learning can be applied there, right? So don't try and do it the other way, because it's not natural way to kind of apply machine learning. So that's what I would do. How NLP can be used in insurance? So NLP gets used in kind of extracting insights from your customer call center data to let's say the discussions which are happening between agents. So some companies have started recording those discussions, and then you can then use NLP to extract information out of it. Social media analytics is another use case for NLP. So brands monitoring their sentiments on social media is another thing. So those are some of the use cases. How to use machine learning in pricing? So machine learning in pricing, so pricing traditionally has been more actuary based. Again, it depends on country to country, but in India, there is a regulatory requirement that you have to stick to a few guidelines. So in that case, it's difficult to kind of apply machine learning, especially black box approaches. In economies which are more open, you can use that to come up with better pricing models. Are the job role of actuaries underwriters same as analytics professionals? Sudipto, right now the answer is no. So typically companies would have a team of actuaries, a team of underwriters, and there might be an analytics team as well. but that's changing very quickly. So companies need to become more and more dynamic with their underwriting practices and their actuary practices. So I personally think that these differentiation would go down. You would obviously need industry perspective and experience, but the skills would be transferable. Uh, Samir is asking, would like to understand what all techniques, logic for fraud detection. So again, the techniques start from applying basic classification techniques. The big thing to keep in mind is these are highly imbalanced problems. So you would need to kind of either do resampling or try some of the techniques to handle non-balanced classes. You would also typically rely on a few detective agencies or a few additional data scripts for cases where you're not sure. So typically what is done is you flag some of the you flag some accounts and then do a deeper dive or ask a third party to do a deeper dive on these cases. Banks which don't manufacture insurance product but act as brokers of insurance to sell them, are there any analytics use cases for them? Very good question again. So the biggest use case for these banks would be the cross sell of these insurance products. So for these banks, typically insurance is a very profitable arm of business, because you kind of get those commissions and you don't kind of underwrite the risks yourself. There is someone else who is underwriting the risks. So for a bank, typically insurance is a very profitable arm. And then the use of analytics would be to identify the customers who take up or where you can do a cross sell to these customers. So let's say your savings accounts have a million customers. You would try and identify which out of these customers are more likely to buy an insurance product, so that your profitability goes high on that portfolio. What are the most popular data visualization tools? Depends again on company to company and scale to scale, but ClickView, Tableau, D3.js, those are the kind of popular visualization tools. Can you please give a brief case study fraud analytics in insurance? So I shared that as part of the presentation. If you have more, if you want more details, feel free to drop me a mail. I'll try and answer that. Are artificial neural nets being used in insurance to do predictive analytics? Right now, I would say that they are in test phase in a few companies I know of. So again, depending on the problem, there are some companies who have started to apply them, but they are not very widely used right now. What can be the most profitable segments for an insurer? I'm not sure about that question. If it is meant to be segments of customers which are most profitable, I would kind of think that there could be lifetime customer lifetime modeling, and then you can use that to kind of create the profit at various segment level. So that could be possibly one answer. So I'll just take two more questions. In real-time marketing analytics, one would need to get accuracy of about 5 to 8%. So what is real-time accuracies? Again, not sure what you're referring to. Let me. So another question, I've heard of personalized pricing on basis of motor data. Can you please tell me if this is implemented anywhere in the world, and what techniques are being used to analyze car or health data? So yes, it is being implemented by a few companies. So typically, the way it works is the telematics data of how you're driving gets. So basically, you have to agree for the person to keep a device on your car, and that continuously transmits the data, and basis that you kind of get your uh, you get your benefit in pricing. So that's basically what that does. I'm not aware of use on the health data yet, but I know there are a few companies who are exploring that. Uh, Finally, I'm heading analytics team of one of the health insurance companies. Uh, these startup talk a lot about fraud, but once it comes to practical application, there is no specific solution. Uh, that's probably true. I mean, getting to a solution of fraud just based on data is difficult. I think the right answer lies in marrying data along with some of the practices which gets followed in the industry today. So I'll be very skeptical if someone comes and says that they can solve this only by using data. But at the same time, solving it without using data would also be not very beneficial. So that's what I would probably uh, right. So again, I'll stop because we've run out of time. Again, thanks a lot for coming for this webinar. Again, it was wonderful to interact with you. As I said, it's a very special day for us at Analytics Vidhya. We complete 4 years today. The domain was booked today, and then hope to see you again in DataFest. There is a machine learning hackathon coming up. There are various skill tests coming up. So, so looking forward to see you all again. Thank you. Thanks a lot.